You know, the rise of AI is shaking up pretty much everything, and that includes the very foundation of how we invest our money. We're about to dig into why even the most successful, time-tested investment strategies are suddenly being put under the microscope in this new age of artificial intelligence.
So get this. This quote is from a veteran investor, someone who made millions over 35 years using just one simple strategy. Now, when somebody with that kind of track record says they're fundamentally changing their approach because of AI, well, that gets your attention, right? It really makes you wonder, what are they seeing that maybe we aren't?
So before we can really get into what's changing, we've got to understand what worked so well for so long. For decades, there's been this simple winning strategy that was kind of the gold standard for building wealth, and it's all about the power of passive investing. I mean, think about it. For the better part of 35 years, a super simple approach has made millions for everyday investors, just consistently putting money into a low-cost S&P 500 index fund. Seriously, it has been a fantastic set-it-and-forget-it way to build wealth, with average returns of over 10% a year. Okay, so what in the world is an S&P 500 index fund? Well, think of it like this. It's basically a fund that automatically takes your money and buys you a tiny, tiny piece of the 500 largest, most important companies in the USA. So instead of trying to hit a home run by picking just one stock, you're kind of betting on the entire American economy to do well over time. And that right there is the magic of passive investing. The logic is so simple but so powerful. Since you own a tiny piece of hundreds of different stocks, you're protected if a few of them crash and burn. As long as the market as a whole keeps growing over time, which historically it has, you come out ahead. It's been an incredible strategy. But, well, there's a new wrinkle in the story. And this brings us to a hidden risk that AI has created. The big question is that diversified fund you own actually, well, not so diversified after all? Okay, look at this number, 40%. Now, just on its own, it might not mean much. But trust me, it represents a massive, almost silent shift that's been happening right under our noses in our own investments. So what is that 40%? Well, it means that for every single dollar you put into a standard S&P 500 fund, a full 40 cents of it goes into just 10 companies. That's right, out of 500 companies, almost half your money is concentrated in just 10 of them. And this chart, wow, it just makes the risk so clear, doesn't it? You think you're buying a nice balanced portfolio of 500 companies, but in reality, a tiny handful of AI-related tech giants are taking up this huge slice of the pie. The other 490 companies are just left to share what's left. That's not exactly the diversification most people think they're getting. Okay, so how did this even happen? Why is it so top-heavy now? It's all because of how these funds are built. It's something called market cap weighting. And the concept is simple. The more valuable a company is, that's its market cap, the bigger its slice of the fund automatically gets. So as a few big tech companies have shot to the moon in value, they've started to completely dominate the whole index. Right about now, you're probably thinking, well, can't we just give every company an equal slice? And you can. It's called an equal weighted fund. But of course, there are trade-offs. The standard market cap fund lets its winners run, which is great, but it creates this huge concentration risk we're talking about. The equal weighted fund gives you that true diversification, but it has to constantly sell its winners to stay balanced, and that can mean higher costs. So you see the trade-off, right? There's really no perfect one-size-fits-all answer here. So this growing concentration risk, it's the exact reason why it's more important than ever that we start broadening our horizons. It's really time we start thinking globally with our investments. Just take a look at this timeline. It tells a really important story about how global market leadership is never, ever permanent. Back in 1900, the UK was the big dog. Then, in the late 80s, everyone was completely convinced Japan was the future. Today, it's the USA. But if history teaches us anything, it's that this can, and probably will, change again. And that really gets to the heart of it, doesn't it? The only thing that's ever really certain in markets is, well, uncertainty. Leadership changes, economies shift, and relying 100% on a single country, even one as strong as the US, is a pretty risky bet against the clear pattern of history. So, what does this actually mean for you? What are you missing out on by only owning US stocks? We're talking about global powerhouses like TSMC, the world's most important chipmaker, Samsung, the electronics giant, and innovators like Toyota and Tencent. These are massive, world-changing companies driving growth all over the planet. All right, so if we're supposed to look beyond the big, obvious names, where do we even start?
Let's break it down with a really simple framework I like to call the investor's four zones. Okay, so check out this grid. It's super simple. On one axis, you have the company's size, its market cap, and on the other, its price or valuation. In the top right, that's the crowded zone. Think big, expensive companies like Nvidia and Meta that everyone is already piling into. Down from that, you have the defensive zone with reliable giants like McDonald's and Coca-Cola. Over in the top left is the speculative zone, smaller, hyped-up companies where investing can feel more like gambling. But that bottom left corner, that's the overlooked zone. This is where you find smaller companies at fair prices, and it's where a ton of opportunity could be hiding.
And this leads to a really crucial idea. Maybe the biggest opportunity in AI isn't about building the next gigantic AI model. The real value, the real money, could come from those smaller, overlooked companies that are simply applying AI to solve real-world problems in a smart, cost-effective way.
And I love this analogy because it just clicks. Once a bunch of different AI models all become good enough, what's going to matter most to customers? Probably the price. The real winners might not be the companies that built the most expensive premium AI model. It might be the companies that use the affordable model in the cleverest ways to help their customers.
Okay, so let's pull all of this together. What does this actually mean for us? The new mindset isn't about predicting the future, it's about preparing for it. So here's a new playbook for navigating this pretty uncertain world. So here's a simple, modernized strategy in 4 steps. Number 1, don't just dump the S&P 500. It's still a fantastic core for any portfolio. Number 2, diversify into global markets, so you're not putting all your eggs in one country's basket. 3, look into funds that focus on those overlooked small and mid-cap companies. The smaller guys with more room to grow. And number 4, and this one is crucial, increase your cash reserves.
And hey, if you think holding cash is just, for beginners or for people who are scared of the market, think again. Warren Buffett, who is arguably the most successful investor of all time, is sitting on a record cash pile of over $347 billion. He's not trying to predict a crash, he's preparing. He's building up his war chest so he's ready when opportunities pop up.
And that really is the heart of this entire shift in thinking. The goal is not to be a fortune teller who can perfectly predict what AI or the stock market will do next. I mean, nobody can do that. The real goal is to build a financial plan that is prepared and resilient enough for multiple different outcomes. So I'll leave you with this one final question to think about for your own finances. In a world that's defined by such rapid change and so much uncertainty, is your current strategy trying to predict the future, or is it preparing for it?